Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Give us just a moment here to go live on all the different platforms, and then we will get started. We're going to be talking about how to structure mixed use property loans here this evening. I see some comments already coming in there in the chat. Go ahead and drop a comment there in the chat. I'm just waiting a moment here to go live on all the different platforms, but it does look like we're live, so we'll go ahead and get it started here. Uh, we will go ahead and get into it here. And if you do have any questions as we go through the presentation, you can drop those questions in the chat. All right. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through a new loan officer training topic. And tonight we're going to be talking about how to structure mixed use property loans. So, I'll let Jose get right into the presentation. Again, if you have any questions, you can drop those in the chat. We can answer the questions after the presentation.
Good evening, everybody. Thank you for joining us for tonight's training on mixed-use properties. This is one of my favorite property types, actually one of my favorite loan types, because frankly, there's very little competition in this niche, right? You've all heard niches, the riches are in the niches, right? Well, that's true for this one, and especially for the product that I'm going to be highlighting today, which is a sort of a hybrid mixed use loan, which requires a residential component, right? So this is not a true commercial, fully commercial mixed use where you have just different commercial property types within the same structure. This is actually a loan that requires at least 50% of the space to be residential. And as you see there in the photo, they actually do require, which I'm going to get into it now, they do require the commercial component to be on the first floor and the residential component to be on the second floor and higher. So let's get right into it. It's pretty confusing sometimes when we talk about a mixed use 2 to 8 unit property. Right? Sometimes people think we're talking about it could be individual units, right, put together into some kind of a portfolio, but it's not. We're actually talking about a specific property type, like the one you see there in the photo. Here we go. Sorry about that. I just realized I was looking at my stuff here. So let's get right into it again, how to structure our mixed-use property loans. So when we're talking about a mixed-use property, we're talking about the kind you see there in the photo, where you see the first floor is commercial, second floor and higher is residential. And that is actually a requirement for these mixed-use properties. But what we're talking about here is one property folio that has multiple units. And for this hybrid product that we have, you do have to have at least 50% of the usable space, livable space, be residential. If you have less than 50% of the space as residential, then it would not qualify for this program, which has amazing interest rates when compared to a regular commercial mixed-use property loan. So this is, though, since it does have a residential component, this is investment only. And this particular option that we're talking about is, as you're going to see in the next slide, it's a DSCR loan, debt service coverage ratio. So this loan does not require any personal income for the borrower. It's simply going to use the gross rental income generated by the property, and you divide that by the housing expense, PITI, and if applicable, association fee, and hopefully you're going to be above 1.0. And actually, for this best options in this program, you're going to be up at 1.1 or above DSCR. But it's very important to note, again, the residential component has to be in the second floor and above. First floor can only be commercial. So the the great thing about this program, like I was mentioning, is that it is a debt service coverage ratio loan, and it does use, DSCR guidelines. Minimum 1.0, like I did mention, but we do have options at 1.0 and above. Minimum 1.1, actually, for the best options. Now, do note this program is a little bit different than your regular DSCR in terms of the rent that they do consider. So please note that if there are current rentals in the property, underwriting will use the lower of the current rent on the appraisal or the market rent. So it would be either the current rent from tenants or the market rent from the 1007, but the lower value will be used. And likewise, when it's a refi, you will have to use the lower of the lease or the market rent on the appraisal. Now, you cannot have a totally vacant mixed use type property and qualify for the loan. So it does have to have occupancy. Even if it's a purchase, it has to have occupancy. This is just, one of the separate twists that they put on this program. Do also note that if there are vacant units, now it doesn't mean you can't have some vacancy, because you are allowed to have up to a 25% vacancy factor, or vacancy. 25% of the units can be vacant. So if it's 8 units, you can have no more than 2 units vacant. And the vacant units, depending on the percentage of vacancy, do get a haircut from anywhere from 10% to 25% of what would be the market rent for that unit. So you do get the vacant unit rent, they just cut it, right? So that's the workaround that they do for this program. Now, I will state here now, though, we do have a mixed use option that is a no ratio DSCR, but that one is more similar to a commercial mixed use loan. I just throw it out there because you're going to see me mentioning a 650 credit score as a possible minimum for some mixed use loans, which we do have, and it's the same no ratio one, which is a more of a commercial mixed use, not as the residential hybrid of that we're talking about here. Because one other very, very important note, I'm glad I started mentioning the commercial mixed use type loans, because whenever you do go to the pure commercial route, first thing they're going to ask you is, what's the address, what's the zip code? They're going to pop that zip code in, and they're going to see what kind of demographics, what kind of numbers in general they get for that census tract, what kind of population. And if the numbers don't work, and especially the population density, they're just not going to, they'll pass on the loan, regardless if you have a 2.0 DSCR, 800 credit score borrower, and a 50% LTV. They don't care if that's on the commercial side, mixed use. But on this residential type hybrid product that we have, they don't, they're not going to look at the zip code. They're not going to care about population density. But what they will care about is if the property is in a rural location, and if the appraisal designates the property as being rural in nature. If it is deemed rural in nature, it's pretty much a dead deal for this 2 to 8 unit mixed use type loan, because again, this is already a specialty product. Specialty products have a higher risk inherently associated with them. So they need to lower the risk factors by eliminating certain components, and definitely the rural component is totally eliminated from this one, just like needing the properties to the not being able to have all vacant units when it's a purchase, for example, and definitely when it's a refi. Just they need to lower the risk factor so that the loan packages can be sold. But definitely the fact that this is our hybrid product, And I guess I might as well spill the beans why this gets me so excited, because the fact is I just priced one of these out today. This was a low LTV. It was a purchase. Customers giving a big down payment, so I think it was going to be like a 55% LTV, and the interest rate was, depending on the closing costs that the customer wanted to pay, the interest rate was anywhere from 7.125 to 8%. So so depending on if they wanted a zero discount point rate, or if they wanted to pay 1 or 2 points, then they could get it. I think at 1.25 points, it was like 7.125 with a 55% LTV. Customer had a 710 credit score. So you go to a commercial conduit with the same loan, and it's going to be 9.5, 9.75, 10, 10.25%. With higher costs associated as well for the borrower, because in this particular case, we are the lender. When it's a commercial loan, we are the broker, and we always get better deals when we're the lender. So I already hinted on it, but let's talk about eligible borrowers and property types. Now, I already mentioned 2 to 8 unit properties with at least 50% of the space as residential. Minimum of 400 square foot per unit. Can't have little tiny units. Each unit needs to have a full kitchen and bathroom. It can be a studio, but a studio has a kitchen, full kitchen and a bathroom. It can't be like a boarding house, right? Where you got a bunch of bedrooms, they share bathrooms, or maybe just share a common kitchen. They may have their own suite, bedroom with a bathroom, but no kitchens. They got to have at least 400 square foot, full kitchen, full bathroom, minimum 2 stories, like I already mentioned. It's not every single type of commercial or component is allowed. For example, no ALFs, no daycare, no nursing home, no manufacturing, no worship, no gambling, no smoke shops, no dirty type business that can cause contamination, like a laundromat where they actually do the cleaning on site, do the dry cleaning on site, should I say. That wouldn't be possible. It has to be like a clean type business, retail, professional office. They're allowing restaurants now, so to have an idea. Now, the present use of the structure has to be the highest and best use, and typically it is going to be the highest and best use when you're looking at a commercial property that has residential and commercial is going to be a higher and better use than if it's just purely residential. I already mentioned cannot be rural. For this particular option that we're talking about, the max LTV on a purchase is 75%, and the max LTV on a cash out is 70%. Now, it's minimum 660 credit score for our hybrid option. Obviously, that's not going to be at 75% at a 660. It's probably going to be like 65 or 60%, something like that. But the minimum 650 score that you see there is possible, still at a 75%, just much higher interest rate, a little bit higher cost, but it is possible 75% LTV with our commercial option for the mixed use, even if it's residential and commercial mixed use like we're talking about here, we're still able to do it at a 650 credit score. Keep that in mind. Eligible borrowers: U.S. citizens, U.S. permanent resident aliens, non-permanent resident aliens. We would have to check if they allow foreign nationals on a case-by-case situation, because it may be that they allow the foreign national if they have U.S.-based credit. But again, the situation with this loan type, again, it is more of a specialty product. So whereas we do have foreign national loans for DSCR, that's not necessarily the case for this hybrid product that we have. Entities, again, this is what you would want this to be: a business purpose loan closing in an entity. The most common entities are LLCs, C Corp, S Corp, and limited partnership. All right. Last but not least, here wanted to share with you investor experience and housing history. Again, this is not for first-time home buyers, but first-time investors will be allowed with an LTV reduction. I believe we can do up to 70% for a first-time investor. The best options at the max LTV are going to require at least 1 year investor experience in the last 3 years. So again, a lot of opportunities here with these mixed use loans. This is a great niche that I recommend everyone to add to their niches of loans that you want to originate. Don't stay just inside the box and want to originate just agency loans or just bank statement loans, but get out there because when you do find the investor that is interested in one of these loans, they don't really have that many options to go to. And they're definitely, if you give them one of these rates like what we're talking about here, 7.5%, 8%, uh, there's a good possibility you're going to get that loan, right? So definitely want to recommend everybody to hit the mixed use loans. Now I want to see if there's any questions out there. Because I mean, this is if anyone has any questions, this is a time for it because the mixed use loans, very unique property type, especially this one that we're offering here, which is DSCR with at least 50% of the units residential.
Well, I don't see any questions, so I guess we'll go ahead and wrap it up then. Great stuff, though. So remember that we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, where we go through a new loan officer training topic. So we'll have some new topics for you next week. We'll see you next Tuesday, 7 p.m. Eastern, for the next episode of the Loan